We're here because free speech is under attack. We're here because people are being convinced that socialism works. We're here because people are being judged guilty until proven innocent. We are fighting back with facts. This is not a safe zone, so buckle up, Buttercup. This is the raw, naked truth.
Welcome to the Raw Naked Truth. I'm your host, Eric Lopkin. And with me for this Wallet Watch Wednesday is Brian Williams from Northshire Consulting. Brian, how are you this week?
I'm doing just fine, Eric. How are you doing?
Doing all right. Yeah, so the market has been a roller coaster lately. We were just talking before we started how, long-term things are still pretty good, but this last quarter or so has been rough.
Well, yeah, it's been interesting. I mean, I do a lot of work in the 401k space, and you have savers now who are, if you're somebody in your mid to late 30s, you've gone almost your whole professional career without really even having any down years. So, Friday was a big down day, and now we're starting to get some volatility back. But there's almost a whole generation now of workers who hasn't had to experience that and may not be totally comfortable with that. The last 10 years, the only down year we had was 2018, and we're only down about 4.5% on the S&P 500. I mean, year to date, as we record this, we're down about 10%. So it makes people kind of, as they start to plow through their March 31st statements, it's like, wow, this is one of the first statements I got that was lower than the one before it, maybe. Obviously we had a rough first quarter when COVID first started in 2020. So we went through that, but I think it's, nobody likes to see their balances go down, but I think in the long term, it's good for people to reassess their risk tolerance and just get a feel for the idea that markets don't go straight up. I mean, listen, we got a 10-year number that's still around 14, and you've got a 15-year number that's almost 10, which are still really good numbers. But this quarter, we're getting a little shakeup, getting a little more excitement back in the business for me.
Yeah, the volatility's been crazy. And of course, people do trade on that volatility. Every time it dips, people jump in to sort of scoop up what they perceive as bargains. But realistically, if you're looking at this from a retirement standpoint, unless you're really close to retirement, this shouldn't really affect your strategy all that much.
No, and I mean, it's that reverse thought process. If you found out gas was on sale at the end of your road for 10% less than it was, gas is probably a bad example, but 10% less than it was a month ago, you'd be like, wow, this is a great deal. I better go fill up. But when the market's down 10%, sometimes people don't think that way. So especially in the 401k accounts, you want to make sure most of the platforms now have automatic rebalancing, which is going to teach you to be a little bit more disciplined and sell the things that are up and buy the stuff that's a little bit down. So that's a helpful feature. And most of the money now flows into what's called target date funds. So they're designed to be built around your anticipated retirement date. So there's a rebalancing mechanism inside of those funds too. So while they're constantly getting you a little bit more conservative as you get older, as your balance grows, they're also making those adjustments inside. So certainly the mechanism now and the technology behind it helps you be a little bit more disciplined than maybe 10 years or so ago.
That's fantastic. I remember when stock trading was, get your broker on the phone and, hope you could get the purchase in at the price you wanted.
Right. And there's still a lot this next generation with the meme stocks and that kind of stuff. And there is still that active trading component, but inside the 401k, it's still mostly mutual funds and mostly securities that are just trading once a day anyway. You're trading, if you buy it at 11:30 in the morning or 2:30 in the morning, you're still getting that end of the day pricing. So even though we have seen more interest in people trading their outside money, outside of their retirement plans, still the 401k business is very much more designed to help you a little bit long term. And a lot of those rules and things are set in place to prevent people from making big mistakes with their retirement money. So it's not necessarily that the technology is behind or that it's more restrictive. It's set in there to help people save themselves from themselves, so to speak.
Right. And technology has brought a lot of new people into the market. Apps like Robinhood, where you can buy one share or even fractional shares now with no minimums. This brought a lot of younger people into the market, and they've never seen volatility like this. They've never seen a bear market. What should they be looking out for?
Well, what they should be looking out for is they need to understand that markets don't always go up. You mentioned the term buy the dip. That's one of the things you see. And I'm pretty active on social media, so I see a lot of the young folks. They see if something drops, they view it as, well, it's going to go back up. So I'm going to buy it. They always think it needs to go back to where it was before, but that doesn't always happen. Sometimes it drops and then drops further. I would say for most people, I know it's not the most fun advice, but make sure you're doing your 401k and getting up to the match, and make sure you have that longer term base established. And if you want to do something on the outside and be a little bit more active with your money on a day-to-day or week-to-week basis, that's fine. But just make sure you're doing your 401k and building up that foundation first.
Right. Now, a lot of especially younger workers who have a 401k, they tend not to participate in any matching funds, things like that. What should younger investors know about their 401k that they should be taking advantage of?
Well, obviously, as you mentioned, the match is probably the most important feature, because if you're putting in 3% and the company's putting in 3%, you're getting 100% return day one. And there's no other investment that anybody could recommend that's going to guarantee you that type of return. So you want to make sure you're getting up to the match. And the other important thing is just the ease of use. We know that people are 15 times more likely to save through their paycheck than they are outside. So rather than have the money come into your checking account, and even if it's drafted out or if you have to write a check, it just doesn't happen as frequently. So if you can take that portion of your paycheck and put it into your 401k, it just makes it so much easier that way. You also want to take a look at your fees and expenses with the 401k. I'd say in my 2 decades plus in this industry, that's been the biggest shift, and it's a good thing. Is that if you had a small 5-person bakery or something, you could never have as good a 401k plan as, for example, in Connecticut, United Technologies or one of the big companies. But that's really not the case anymore. It's been very much streamlined and stripped out so that the fees and expenses within your 401k can be competitive with any size company. But there's still a lot of legacy plans out there that are very expensive. But I would say if you've got a plan, at least participate, do something. Most of them don't have minimums. Do 1% of your paycheck, do $5 a pay period, just do something. And you'll be surprised how quickly it can add up over time.
Great. Well, thanks for that advice, Brian. It was great having you here.
Great to be here. Thanks, Eric.
As always, we want to remind our listeners that everybody's situation is different. Check with your personal financial advisor before making these decisions. And that's the Raw Naked Truth. You can catch every episode of the Raw Naked Truth, as well as the rest of the Xvadio Podcast Network at xvadio.com/podcasts, Apple Podcasts app, Google Podcasts, Spotify, iHeartRadio, Stitcher, Amazon Music, Audible, and wherever you find podcasts. We'll see you next time.